The 2022 market crash has nearly commenced under our very own eyes. In this video, we are going to go over how the change in policy will affect home buyers. And it's all going to happen thanks to one man. This is Jerome Powell, the chair of the Federal Reserve. The Fed has already begun inadvertently raising mortgage interest rates. You may say these higher mortgage interest rates were due to Ukraine. You're kind of right, but then again, interest rates were already rising before Ukraine. They just rose even higher because of the Ukraine crisis. So eventually it was going to get to 4%. He is proposing monetary policy, which is typically used to combat inflation. And they combat inflation by rising interest rates. Okay, look at this. January 21st, right? And we keep on going up to the months. Eventually, May 21st, 2021, it reaches 5%. And then we skip all the way to January 2022. It has reached 7.5%. Now, since the Fed is going to stricken the money supply, here's what I think is going to happen to the housing market. I truly believe a recession has to happen. We have reached a problem to where the middle class is so far below the rich, to the point where Americans cannot even afford rent. The rich, they need the middle class. And if the middle class can't afford, the rich is going to have to come down too. I want you guys to look closely at this graph. This is the changes in eviction feelings. As you can see, this is the average. The average is this line right here. And then we can just see that feelings are up 164%. And this is in Houston, 164%. And this is March. We're just into March. And then we have February, feelings are up 65%. Americans have not been able to keep up with rent. The median landlord claimed their tenant nearly owed them $3,000. I know I am talking against renting. Even though it's more expensive, I do think a housing crash will happen. And this is not, everybody knows this is not sustainable. So eventually you will have more bang for your buck. If you buy a house in today's market, once the market comes back together, and it all depends. If you plan to sell this house fast, then cool. But once the market gets back together, you're going to lose equity. Your house is only up because of demand. You're going to lose that equity. So you're actually going to have a negative return. Once all these houses getting built, it's over. America has almost been building enough homes. Building permits are comparable to 2006. So I'd rather you guys not lose equity. Once these wealthy investors realize demand is decreasing due to supply catching up, we're going to see a mass sell-off on these homes before they decrease in value. Real estate investors own at least 20% of the housing market, which isn't a low number. This is a record high number. And once the housing market hits, that's 20 million lower price homes hitting the market. Once more inventory hits, they'll have to compete more, forcing them to lower rent, which means these investors won't profit anymore because they paid for a inflated property and they can no longer charge high rent because demand just isn't there anymore. Demand is slowly decreasing due to unaffordability. We are already starting to see this. Mortgage applications have decreased to 13.1%. I like to amount this to consumer frustration. Buyers are sick of looking months for the right home. They already accept the fact that they can't get their dream home. And then they're thinking, okay, I can't let these interest rates pass up me. I have to get a house right now. And then they make an offer for a home they are just content with. They don't really necessarily like it, but they're all right with it because they just want a home. They still got outbidded out of the market by a wealthy investor. Now they wasted a lot of time and energy, not to mention the emotional stress of constantly hearing the word no because the offer isn't outright good enough. Not to mention the rising gas prices have already got you in a bad mood. But my advice to soon-to-be buyers, stay out of the high-profile metro areas. Here's why. Let's take one of the biggest bubbles right now, Austin, Texas. It has some type of high incentive to move there because of its expanding economic industry. More buyers move there because the current remote job trend. Companies like Google and Tesla plan to move operations over there, showing signs of the next Silicon Valley of some sorts. Well, there was an adverse effect. This spiked up housing prices to 51%, not to mention leaving them currently with less than a month of inventory, 0.4. Houses are selling out faster than the Popeye's chicken sandwich situation we had years ago. Some agents are getting up to this is just an estimate, at extreme cases, 65 offers on one home. It makes sense. These high metro areas is where the jobs are at, and the investors know that. But once the Fed meets up and abruptly raises up interest rates to combat inflation, mom and pop investors are going to have a bad time. This is a good example. In 1981, inflation was at 14%, and the Fed raised interest rates to 19%, but it did put a good deal of inflation down to recover the economy. All I'm saying is the Fed is going to utilize the same techniques as 1981. Granted, it's probably not going to be as serious. It might not be this year, but it's going to be one of these years.